Hello and welcome to Moneycontrol. Hi, this is Nikki. Tata Steel has reported better than consensus Q1 numbers. What is coming as a surprise has been the European EBITDA performance. But to know more about the numbers, micro trend, let's bring in our guest, who's the managing director of Tata Steel, Narendran. Hello and welcome to Moneycontrol, sir. I'm going to start off by asking you about your European division performance because that's where the surprise is coming from. It's for the first time, perhaps, that we're seeing that the European EBITDA performance has been better than that of India's standalone performance. How sustainable are these numbers right now?
Thanks, Nikki, for having me on the show. Yes, Europe has had a very strong quarter because we've been helped by the long-term contracts that we have in Europe, which hurt us last year when the steel prices were going up, but our contracts were at fixed prices. But this year it's helping us when steel prices were going down. So that's been the reason why in Europe we've had a strong performance. In addition, of course, we've continued to work on driving operational efficiencies and taking out costs. We've brought in sharper focus on the business by separating the UK and the Dutch business and running it with a very different kind of sharper focus. So multiple reasons. I think in terms of is it sustainable, I do believe that the spreads in Europe will continue to be better than what we've seen on an average for the last decade or so because multiple factors have changed in Europe. Also, the cost structure in Europe is changing because gas prices are going up, inflation is there. So all these lead to steel companies operating, at higher cost levels than they've done traditionally, and that will also keep the spreads at a higher level. But yes, India business is fundamentally a very strong business. We've had a challenging quarter because of the export duty, etc. In the medium to long term, obviously, the Indian business will continue to be stronger than the European business, but the European business is able to stand on its own now.
Sure. When you say you expect Indian business to be stronger as compared to that of European business, what's the standalone EBITDA per ton number now that we can expect even from Indian business? And also, um, back to the European business guidance, do you still expect a $300 plus number coming in for the European EBITDA per ton?
So both the Indian business and the European business will see a margin compression in Q2 because the costs are continuing to go up. It will start coming down by September because the impact of lower coal prices will help us only by September or October because we are buying that coal today. By the time it's used, by the time it comes to our plant sites and gets used, it's going to be another 2 months. So I think you'll see the costs coming down in a couple of months. The prices are already lower today than it was at the beginning of the quarter. So you will see margin compression. But what we expect in this quarter is to see a volume expansion. We expect to sell more volumes this quarter than we did the previous quarter because steel prices are more stable and we're seeing a lot of demand coming back. Why I say the Indian business is structurally stronger is because in India, we are fully backward integrated. We have our own iron ore and we have about 15 to 20% of our coal. Whereas in Europe, we have to buy 100% of the iron ore and coal. So the India business has some advantages. The second big advantage India business has is it's a growing market. We're adding capacity. So a lot of costs get distributed over higher volumes year on year. And that helps us deal with inflation. Whereas in Europe, when the volumes are fixed, you need to counter inflation by taking out costs. You don't have volume growth as an advantage to take out costs. So these are the reasons why the India business will always be more profitable than the European business. But the Netherlands business is going to be one of the most profitable steel businesses in Europe because our Dutch plant is very well positioned, is very competitive, and is structurally very strong and one of the strongest plants in Europe, actually.
When you say margin compression for Q2, what's the kind of compression that are we looking at in terms of percent, both for the standalone Indian business as well as the European business?
So I'm not going to give a specific guidance because things are still quite volatile. I will just say that, like I said, steel prices in June are much lower than steel prices in April. Q2 prices will be closer to June prices than to April prices. So you can do a bit of the math on that. So it will be lower. But
Would you
we are
do a
looking
sensitivity
at the
analysis for
cost
a
we can take out.
15% fall in the HRC prices? What's the impact that we'd have on EBITDA?
No, but again, it's not just the fall in prices. We are also looking at how much of the cost benefit can we get. We
But that
already
was in
expect,
Q3, right?
we expect, yeah, but we expect at least $40 cost takeout as far as coal prices are concerned on a consumption basis. We're already buying coal at $150, $160 cheaper than we bought in Q1, but maybe about $40 of that will come through on costs. We are looking at other consumables as well, because all other consumable prices are coming down. So I won't give a specific guidance on margin. I will only say that margin per ton in Q2 will be lower than Q1.
Fair enough. I'm just going to touch base on few reports that we've been reading through, which says that Tata Steel may shut down the UK operations if the British government does not pay a specific sum of an aid coming in for the green plans. I think that number is to an extent of 1.5 billion pounds, if I'm not wrong. How do you read into that statement, and would you completely agree to the fact that the company is looking at a potential shutdown maybe for that UK operations?
No, I think there are multiple aspects to it. The 3 billion number which was put out there is a number from the media. That's not a number from Tata Steel. But the fact is that, yes, we have sent a proposal to the British government a couple of years back, because we believe that while the business is able to sustain itself for now, it is positive EBITDA and cash neutral or cash positive. There are significant investments which may come our way over the next few years, because some of the assets are reaching end of life. But our proposal is to say that instead of investing in existing assets, can we invest in newer assets which are greener, which is a greener process route, leveraging the scrap that is available in the UK, and helps the UK government also reduce the carbon footprint that they want to reduce in the UK. Like it is so in other countries in Europe and in the US, governments are supporting industry make this transition to a greener future. Spain is supporting industry, Germany is supporting industry, Canada is supporting industry. So our request is not unusual, I think, and we are a very important part of the UK manufacturing chain. We supply more than 50% of the steel that's used by auto companies, packaging companies, construction companies in the UK. So there are multiple reasons why we believe that it can be mutually beneficial for the government and us to work together to find a greener solution. So I think that was a statement that was made, that the existing business will be run as long as the cash flows can support it, which is true today. But as
And
we
also,
reach
what's
some
the
of
number
the,
that we have put in the proposal, sir? What's the
sorry,
number that we have put in for the proposal? What's the
well,
financial aid that we are looking at? If you can put a number to that.
it's less than 3 billion, but it will be a significant amount, because we put in this proposal 2 years back. Once we have a go ahead, then we'll work out the final numbers.
So is it 2.5 billion kind of a number that we're looking at, or maybe less than that in that case?
Slightly less than that, I would say.
Okay. Okay, I would also want to chat about the optimum visibility that you have both for your UK as well as Netherlands business, especially in terms of the energy security, because that seems to be a bit of concern, and the sustainability capex. A word on that one.
So I think there are short-term and long-term issues. In the short term, gas prices have been going up, but I think neither of our businesses are at risk just now, because in Netherlands, both as a country and as a company, we have fulfilled the goal set by the European Union, which is for each country to reduce the gas requirements by 20%, Netherlands or 15%. Netherlands has already reduced it by 20%. And we are not so dependent as a company just now on gas. We are more dependent on coal. So we are not going to, business is not going to get disrupted. Gas prices have gone up. That's a OPEX issue. And we are hedged for most of those costs going forward. Same in UK. So there is no short-term disruption. But in the long term, the transition in Netherlands is about substituting coal with gas, and then eventually substituting gas with hydrogen. So when we look at making investments in assets which use gas instead of coal, we want to be sure that gas is available at a reasonable price and consistently. I think so far we have the assurance that it will be available, but before we put money on the ground, we'll make sure that we have that comfort. In UK, we would be less dependent on gas, more dependent on electricity if we convert into a recycling-based steelmaking facility. And for that, we are in touch with the government so that energy is available at a competitive price.
Mr. Narendran, I was also listening into a con call earlier in the day when you suggested that energy cost has risen substantially, almost three times than the levels that we've seen in the previous year. Any kind of guidance coming in on that one? What kind of pricing do you now expect?
So I think if you compare to what gas prices were maybe 2 3 years back and compare it to today. That's the reason why the money we spend on gas is three times what we did earlier. But like I said, our biggest energy source is coal rather than gas today. So to that extent, we are more vulnerable to coal prices than to gas prices. But having said that, we do expect that in the next couple of years, as Europe reduces its dependence on Russian gas, uh, we will see gas prices settling. There is a lot of investments going on currently on LNG because so far Europe was dependent on pipelines bringing gas from Russia, but they're investing more and more so that LNG can come from other parts of the world to the ports in Europe. UK is already quite well equipped to import LNG. I think European ports are also building those capabilities. So we expect in the next year or two that the vulnerability to gas prices out of Russia will be less.
I'm going to touch base more on the macro front now since we have you with us. Because there are concerns that are around the Indian economic growth that may slow down, which are hit by the global supply shortages and, of course, some amount of input pressure also. The Reserve Bank of India is expected to stay hawkish given the kind of elevated inflation that we're witnessing. What is your view now on the entire situation, and what kind of impact can we expect on the steel industry?
Sure. I think the Reserve Bank will obviously watch to keep inflation under control, rightly so, because inflation impacts the poorer sections of society much more, and there's good reason then to manage that. Secondly, it will also have to watch what's happening with Fed and what the US is doing as far as interest rates are concerned. Otherwise, you run the risk also of devaluing the rupee in some sense of the term if there's a big disparity in interest rate movements between the US and India. So these are two things to be kept in mind. What would be the impact? Honestly, I think, if you really look at what is driving demand in India, most of the sectors continue to be strong. Auto has had one of the strongest quarters in a very long time, and a lot of auto is bought using loans. So despite some increases in interest rates, that is not gone down. I mean, that is not impacted. If I look at construction, a lot of the construction activity is going to be driven by government expenditure. And as far as housing is concerned, property is concerned, again, India is quite strong, and there's going to be a lot of low-cost housing which is going to be built. And the other areas which drive demand of steel are oil and gas, uh, railways, and all of them continue to have big expenditure plans because of the focus on infrastructure. So I think macroeconomic activity, I mean, the GDP will continue to be strong. It may not be the 9%, 10% we all expected some time back, but even if it is around 8%, I think it's fantastic. And, as far as industry is concerned, yes, if we have a bad balance sheet, then you could get impacted. But I think many balance sheets have been repaired over the last few years. So I think industry is less vulnerable to rising interest rates than they were maybe a few years back.
That's interesting takeaway, I would say. But I would also want to understand you're reading into global cues right now, especially in the background of the entire Ukraine crisis, which has led to a supply chain disruption. Are you expecting any kind of improvement in that situation anytime soon?
Well, I think obviously it's anybody's guess how long this turmoil will last. But one positive development has been the recent agreement between Russia and Ukraine on wheat exports, because that was to me probably the biggest problem to solve, given its impact on many poorer countries dependent on imported wheat from Ukraine. So I think that's been a food crisis which has been averted to some extent. But having said that, yes, the more this war prolongs, the conflict prolongs, uh, it's going to be quite disruptive for Europe. But post this conflict, I think I see a few things happening. One is, of course, Europe will spend more on defense. Europe will spend more on green infrastructure. Europe will also spend more on recovery. So I think, while there are some short-term pressures, in the medium to long term, I see economic activity coming back. Maybe at a higher interest rate level than we've seen in the past. So a lot of money flowing into speculative businesses may dry up a bit, but I think the fundamental businesses, the core businesses, the infrastructure-led businesses, commodity businesses, I think we'll see a fairly strong period ahead.
Fair enough. I would also want to touch base on your acquisition plans because over the last 3 to 4 years, we've seen number of acquisition happening, when you talk about Bhushan Steel, Usha Martin, Nilachal, all of these put together, what is the company's strategy right now when it comes to M&A opportunities? Is the company still open, or would it now want to focus more on the inorganic route or the
Yeah.
organic route?
We will focus more on organic growth going forward, because I think because of what we did as far as inorganic growth is concerned over the last 3 years, we now have enough options. So we are in a position where we have multiple operating sites with headroom to grow. So we have the Kalinganagar site, which is being expanded from 3 million to 8 million. That can go to 16 million tons. We have the Bhushan site, which is, we took it from 3 to 5 million. That can go to 10 million. The Nilachal site, which you've just acquired, is going to go to 1 million, which is existing asset base, can go to 10 million. So between these sites and our Jamshedpur site and a few smaller sites that we are developing for electric arc furnace-based operations, we have enough headroom to grow to 40, 45 million tons during this decade. So that kind of fulfills our growth ambition. So we don't really need to acquire any new sites or have any more inorganic growth to fulfill our growth ambition. So I think we have the options, and brownfield expansion allows us to pace our expansion well. So we can expand in multiple sites or at one site. We can choose how to grow, the most capital efficient way to grow, and adapt ourselves to the changing situation in the country. And we have a healthy balance sheet now.
I'm going to touch base on the balance sheet in a bit, but before that, I'm just going to ask you about the natural. You've just taken the ownership. When does the company expect the benefits to just percolate down into the financials?
So, this plant has been shut for more than 2 years. So just now the teams are focused on getting the plant started. We expect to start the blast furnace sometime in the next 3 months, hopefully by the end of September. And by March next year, we want to be running the plant at 100,000 tons a month, which is the rated capacity. So that's a plan. I think we have enough talent who have been deployed there. The local talent is already there. And we have the experience of turning around Bhushan and Usha Martin. We are confident that we'll be able to do the same with Nilachal too. And then as we do this, we will also parallelly make the plans to expand from 1 million to 5 million. And in the next 6 months, we'll, have concrete plans so that once we reach the rated capacity, we move on to the next stage, which is the expansion of the existing facilities.
Okay, I'm just going to ask you quickly 2 questions before I let you go, because it's something that I'm really keen on. Indian HRC prices, where do you see them finally settling in? Because we've seen a 15,000 rupees per ton, I think, slide coming in from the Q1. Where do you see the supply cuts finally kicking in?
I think, Nikki, we've pretty much reached where it should be, or where it kind of bottoms out for a few reasons. One is internationally, if you look at it, China, which is an exporter, is already losing money exporting at these prices. So I don't see much headroom in China to bring down prices anymore, since the middle of June, Chinese companies are at negative margin, exporting. So that is one thing. Second thing is, in Q1, because the prices fell so rapidly, a lot of demand or purchasing got postponed. So the fundamentals were not as bad as it seemed, because people were just deferring purchases, saying that next week price will be lower than this week. Now that period is behind us, so we see demand coming back, more and more customers wanting to buy, either to restock or to get the businesses going. And post monsoons, we expect it to take off really well. We have an early festive season. Normally festive season is a good time for multiple reasons. So I think flat products have pretty much bottomed out. We will see prices stabilize and then start picking up towards the end of the quarter. Long products, already prices have started creeping up. So, because long products, 50% of the production in India is vulnerable to thermal coal prices. And thermal coal prices today are higher than coking coal prices, which is unusual, but that's because Europe is buying a lot of thermal coal. So I think these dynamics will come into play. Headroom, there's very little headroom to drop prices any further. And and things will stabilize and start moving up.
And the thermal prices are higher than the coking coal. That's perhaps the factor which has happened also in the first time in the last 10 years, if I'm not wrong. I'm also
Absolutely.
going to touch base on the net debt issue, because that's something, because we wanted to chat about uh, the number going up sequentially. What explains this, and what are the steps now that the company would take to bring down the number?
So I think a lot of the reason why the net debt has gone up from 51 to 54, is largely because of working capital. If you really look at working capital over the last few quarters, because of the fact that input costs have gone up and finished product prices had gone up, the working capital in the system went up very significantly over the last few quarters. So, and this quarter, there was also inventory built up. We see all this unwinding as coking coal prices come down. You will unlock value from the working capital, and as our steel sales improve, we will get the finished goods down. So I expect a lot of working capital release. So despite the Nilachal acquisition, which will have an impact on the net debt this quarter, uh, and all our capex plans, etc., we are still standing by a goal of reducing the net debt by $1 billion during the year. So we hope to finish the year closer to 45,000 crores. We started the year at maybe 50 on 52,000 crores.
So you expect your net debt to go by how much, higher by how much sequentially?
No, this quarter it will go up because from
Yes, sure.
54,000, you should add 12,000 crores for what we paid to Nilachal. Our net debt will come closer to our gross debt. If you see our gross debt, uh, you know, we kept that money for Nilachal, and that's why the gross debt is high. So 54 will certainly go to 66 for sure. Just now, it's already gone because first week of July we paid for Nilachal, and now during the quarter we will start unwinding the working capital and pulling back some of the cash from that.
Get your point. The last one that I'll squeeze in, not more than that. Export duty reversal. When do you expect that to happen? And any ballpark number that we can, I mean, the date that we can look at, any timelines that we can look at, because Mr. Shashagri Rao said that it's going to be by Q3 of this financial year. So would you want to stick to that?
I don't know. The government has promised us it's temporary and they will move it as soon as possible, but I don't know when. I think the government accepts that this is not a long term policy issue, it's more a tactical issue. So I think now
Sure.
that steel prices have come down to the levels at which steel companies are struggling, I think it's a good time to remove the export duty.
All right. So we'll leave it at that. Thank you so much for taking out the time and speaking to Money Control.
Thank you. Thank you, Nikki.